All right. Okay, this is the last recording that I'm going to do now. It's several pages, but this is actually not bad compared to the other 3 packets of other things. I'm just listening to everything as repetition through the night and just trying to let everything sink because I really do need to grasp everything. So we're jumping into types of life policies. Now, with this chapter, it's about the major types of life policies, their characteristics and functions, and who is best served by each type. This also includes discussion about annuities. Dun dun dun. It teaches you about the parties to the annuity and annuity period and how to recognize different classifications of annuities. Now, annuities are amazing, but they are a bit complex. Okay, terms to know: attained age. The insured's age at the time the policy is insured or renewed. Cash value, a policy savings element or living benefit. That's cash value. Face amount, the amount of the benefit stated in the life insurance, in the life insurance policy. Deferred, withheld or postpone until a specific time or event in the future. Endow, the cash value of a whole life policy has reached the contractual base amount. Level premium, the premium that does not change through the life of the policy. Liquidation of an estate, converting a person's net worth into a cash flow. Non-forfeiture values, benefits in a life insurance policy that a policy owner cannot lose even if the policy is surrendered or lapsed. Policy maturity. In life policies, the time when the face value is paid out. Securities, financial instruments that may made for value. They may trade for value, for example, stocks, bonds, options. So, number 1, term life insurance. Excuse me, long day. Term life insurance is temporary protection because it only provides a coverage for a specific period of time. It also is known as pure life insurance. Term policies provide for the greatest amount of coverage for the lowest premium as compared to any other form of protection. There is usually a maximum age above coverage that will not be covered or which coverage cannot be renewed. Term coverage provides what is known as pure death protection. If the insured dies during this term, the policy pays the death benefit to the beneficiary. If the policy is canceled or expires prior to the insured's death, Nothing is payable at the end of the term, and there's no cash value or other living benefits. So it's good and bad. Ah. Know this: term insurance provides the greatest amount of coverage or for the lowest premium. That's true. Know this: term insurance has no cash value. The type of term policies. Here's the type of them. There are three types of term coverage available based on how the face amount, death benefit coverage, or changes during the term policy. There's level, increasing, and decreasing. Regardless of the type of term policy purchased, the premium is leveled throughout the term policy. Only the amount of death benefit may fluctuate depending on the type of term insurance upon selling, renewing, or converting the term policy. The premium is figured at the attained age of the insurer's age at the time of the transaction. Note that the topic of increasing term insurance will not be covered further in this course material as it not required. So you don't need to know the increasing. So we're going to talk about level term. Level term is the most common type of temporary protection purchase. The word level refers to the death benefit that does not change throughout the life of the policy. Know this: level in level term refers to death benefits which does not change. Annually renewable term coverage or also abbreviated as ART, is a purest form of term insurance. The death benefit remains level in the sense that it is level term policy, and the policy may be guaranteed to be renewable each year without proof of insurability, but the premium increases annually according to the attained age as the probability of death increases. And then there's decreasing term. Decreasing policies features the level term and the death benefit that decreases each year over the duration of the policy term. Decreasing term is primarily used when the amount of needed protection is time sensitive or decreases over time. Decreasing term is commonly purchased to ensure the payment of mortgage or other debts. If the insurer dies prematurely, the payment of the amount of the coverage hereby decreases at the outstanding loan balance, decreasing each year. A decreasing term policy, usually convertible, however, is not renewable since the death benefit is $0 at the end of the policy term. Return of premium. Return or ROP, return of premium life insurance is an increasing term insurance policy that pays additional death benefits to the beneficiary equal to the amount of the premiums paid. The return of the premium is paid if the death occurs within a specific time period or if the insured outlives the policy term. ROP, return of premium, policies are structured to consider the low risk factor of term policy, but at significant increase in premium costs, sometimes as much as 25 to 50% more. Traditional term policies offer a low cost, simple death benefit for a specific term, but have no investment component or cash value. When the term is over, the protection of the term policy, but if the insurer remains healthy and still alive once the term limit expires, the insurance company guarantees a return of premium with the ROP. However, since the amount returned equals the amount paid in, the return premiums are not taxable. Special features. Most term insurance policies are renewable, convertible, or renewable and convertible, R and C. Renewable. The renewable provision allows the policy owner the right to renew the coverage at the expiration without evidence of insurability. The premium for the new policy will be based on the insured attained age or current age. For example, a 10-year term policy is renewed and can be renewed at the end of the 10-year period for subsequent 10-year period without evidence of insurability. However, if the insurer will have to pay the premium that is based on their attained age. If an individual purchases a 10-year term policy at the age of 35, they will pay the premium based on the age of 45 upon renewing the policy. Convertible. The convertible provision provides the policy owner the right to convert their permanent insurance policy without evidence of insurability. The premium will be based on the attained age at the time of the conversion. Now, traditional whole life products. Permanent. Life insurance is generally the term used to refer to various forms of life insurance policies that build cash value and remain in effect for the entire life of the insured until the age of 100, as long as the premium is paid. Most common type of permanent insurance is whole life. Whole life insurance provides lifetime protection and includes a saving element or cash value. Whole life policies endow at the age of 100, which means the cash value created by the accumulation of premium is scheduled to equal the face amount of the policy at the age 100. The policy premium is calculated assuming that the policy owner will be paying the premium until that age. Premium for whole life policies are usually higher than for term. Yeah, that's true. Level. The following are key characteristics of whole life insurance. Level premium. The premium for the whole life policy is based on the insurer's attained age. Therefore, it remains the same throughout the life of the policy. Death benefit. Death benefit is guaranteed and also remains leveled for life. Cash value. The cash value created by accumulation of premium is scheduled to equal the face amount of the policy when the insured reaches the age of 100, which is the maturity date, and is paid out to the policy owner. Remember that the credited to the policy on a regular basis and have no guaranteed interest rate. Living benefits. The policy owner can borrow against the cash value while the policy is in effect, or can receive the cash value when the policy is surrendered. The cash value is also called non-forfeiture value. Does not usually accumulate until the third policy year and grows tax deferred. Know this: whole life insurance provides lifetime permanent protection and accumulates cash value. The three basic forms of whole life insurance are straight whole life, limited pay whole life, and single premium whole life. However, other forms and combinations plans may also be available. So, straight life. Straight life also refers to ordinary life or continuous premium whole life. Is the basic whole life policy illustrated above? They have a picture. Yeah, like that, right there. That one. The policy owner pays the premium from the time of the policy is issued until the insurer's death at the age of 100, whichever occurs first. Of common whole life policies, straight life will have the lowest annual premium. Limited payment. Unlike straight life, limited pay whole life is designed so that premiums for coverage will be completely paid up well before the age 100. Some of more common versions of limited pay are 20-year pay life, whereby the coverage is paid in 20 years. The life pay up at the age of 65, whereby the coverage is completely paid up by the insured's age of 65. All other factors being equal to the type of policy, as shorter premium paying periods than straight life insurance, so the annual premium will be higher. cash value builds up faster for limited pay policies. Limited pay policies are well suited for those insured who do not want to be paying premium beyond a certain point in time. For example, an individual may need some protection after retirement, but doesn't want to be paying premiums at the time. A limited pay up to 65 policy purchased during the person's working years will be accomplished for that objective. Single premium. Single premium whole life is designed to provide level death benefit to the insured until the age of 100 for a one-time lump sum payment. The policy is completely paid up after one premium and guarantees immediate cash. That the policy owner will be paying the premium till that age. Premiums for whole life policies usually we already did that. Now we're jumping into annuities. Annuities, oh, they're so fun. They're the most complicated. Annuities. Wait, before that, I have sticky on here. Or still before annuities. We're looking at term single premium whole life. They have term whole life, the life of protection, temporarily permanent until the age of 100. Premium level and the death benefit level. They have the death increasing, and they have variable life, where the face amount is flexible, set by the policy owner with proof of insurability. Cash value is guaranteed at a minimum level. General account, and there could be policy loans for variable life. Okay. Now, combination plans and variations. This is like married. Joint life, first to die. Joint life is a single policy that is designed to insure two or more lives. Joint life policies can be in the form of term life insurance, permanent insurance. The premium for joint life would be less than the same type, and the amount of coverage on the same individual. It is more commonly found as joint whole life, which functions similarly to an individual whole life policy, with two major exceptions. One, the premium is based on the joint average age that is between the ages of the insured, and two, the death benefit is paid upon the first death only. A premium-based A premium based on joint age is less than the sum of two premiums based on individual age. So it is common to find joint life policies issued on spouses. This is particularly so if the need for insurance is such that it does not extend beyond the first death. Joint life policies are used when there is a need of two or more persons to be protected. However, the need for insurance is no longer present after the first of the insured dies. Joint life is also used to insure the lives of business partners. In the finding of buy-sell agreements and the other business life needs. A buy-sell is a business continuation agreement that determines what will be done with the business in the event an owner dies or becomes disabled. Know this: premium rates on a joint life policies are determined by the average ages of both the insured. Survivorship life. That's the second to die. Also referred to second to die or last survivor policy, which is the same as joint life in that it insures two or more lives for the premium that is based on a joint age. The major difference is that survivorship life pays on the last death rather than upon the first death. Since the death benefits is not paid until the last death, the joint life expectancy, in a sense, is extended. Results in a lower premium than which is typically charged for a joint life, which pays upon the first death. This type of policy is often used to offset the liability of the estate tax upon the death of the last insured. Know this: joint life or first to die is first to die, and survivorship life is the second to die or the last survivor. Now, annuities, principles and concepts. Dun dun dun. An annuity is a contract that provides income for a specific period of years or for life. An annuity protects individuals against outliving their money. Annuities are not life insurance, but rather a vehicle for accumulation of money and liquidation of an estate. Annuities are marked by life insurance companies. Licensed life insurance agents are authorized to sell some types of annuities. Annuities do not pay the face amount of death of an annuitant. In fact, they do the opposite. In most cases, the payment stop upon the death of the annuitant. Annuities use morality tables, but these tables reflect a longer life expectancy than the than indicated the than in a longer life expectancy than the morality tables used for life insurance. Morality tables indicate the number of individuals within a specified group: males, females, smokers, non-smokers, starting a certain age or are expecting to be alive at a succeeding age. Parties, the owners. The purchaser is the owner. We're talking about the owner of the annuity. The purchaser of the annuity contract, but will not necessarily be one who receives the benefits. The owner of the annuity has all the right, such as naming a beneficiary and surrendering the annuity. The owner of the annuity may be a corporation, a trust, or another legal entity. Annuitant, the person who receives the benefits or payments from the annuity, whose life expectancy is taken into consideration, and for whom the annuity is written. The annuitant and the contract owner do not need to be the same person, but most often are. A corporation, trust, or other legal entity may own annuity, but the annuitant must be a natural person, no aliens or dog. Not yet. So, annuitant must be a natural person. Know this, because annuities are based on life expectancy, the annuitant must be a natural person regardless of who owns the policy. Beneficiary, the person who receives the annuity assets, either the amount paid into the annuity or the cash value, whichever is greater. Excuse me. If the annuitant dies during the accumulation period, or whom the balance of the annuity is who the annuity benefits are paid out. The accumulation period. The accumulation period is also known as a pay-in period. This is a pay-in time over which the owner makes payments or premiums into annuity. Furthermore, I have to make sure we have the right one. Okay. Furthermore, the period of time at which the payments earn interest on a tax-deferred basis. The annuity period, also known as annuitization period or liquidation period or payout period, is the time during which the sum that has been accumulated during the accumulation period is converted into a stream of income payments to the annuitant. The annuity period may last for a lifetime of the annuity or for a specific period, which could be longer or shorter. The annuitization date is the time when the annuity benefit payout begins. As a trigger for benefits. Know this. During the accumulation period, funds are paid in to the annuity. During the annuity period, funds are paid out. In, out. Okay. Annuity income is based upon the following: the amount of premium paid or cash value accumulated, the frequency of payment, the interest rate, the annuitant's age and gender. An annuitant whose life expectancy is longer will have smaller income installments. For example, the factor is equal a 65-year-old male will have a higher annuity income payment than a 45-year-old male because he's younger. A 65-year-old woman or female statistically will have a longer life expectancy. Know this: shorter life expectancy, higher benefit. Longer life expectancy, lower benefit. Annuities are purchased for the most part to provide or supplement retirement income. In addition, they are also purchased to fund or help fund college education. Actually, an annuity can be used for any situation that requires steady stream of income at some point in the future. Annuities are also used to provide what is known as a structured settlements. A structured settlement would take on the form of a court settlement arising from a civil lawsuit, or it may take on the form of income provided to a winner of a state lottery. In addition, many settlement options for life insurance policies usually involve selecting a annuitant payment option. The basic function of annuity is that of liquidating premium sum regardless of how it is accumulated. Now we're getting into types of annuity that can be can be classified according to low premium that are paid into annuity, how premiums are invested, and when and how premiums are paid out. Know this: classification of annuities. Premium payment method, a single premium versus periodic. When income payments begin immediate versus deferred. How premiums are invested, fixed versus variable. Disposing of proceeds, pure life, annuity certain, or life refund annuity. The first way to classify annuities can be based on how they can be funded or paid for. There are two options: single premium, one lump sum, or through periodic payments, in which the premiums are paid in installments over a period of time. Periodic payments annuities can either be level premium, in which annuitant lower pays. And I'm starting to jumble my words. Level premium, in which the annuitant or the owner pays a fixed installment, or flexible premium, in which the amount and frequency of each installment varies. Annuity investment options. Annuities can be classified as fixed or variable based on how the premium payments are invested. 1. Fixed annuities provides the following: guaranteed minimum rate of interest to be credited to the purchase payments. 2. Income annuity payments that do not vary from one payment to the next, and the insurance company guarantees a specific dollar amount for each payment and the length of the period of payments as determined by the settlement option chosen by the annuitant, and that is fixed annuity. With fixed annuity, the annuity knows the exact amount of each payment received from the annuity during the annuity period. This is called level benefit payment amount. A disadvantage to fixed annuity is that the purchasing power that they afford can be eroded over time due to inflations. Variable annuity. Variable annuity serves as a hedge against inflation and is variable from the standpoint that the annuitant may receive different rates of return on the funds. That are paid into the annuity listed. Below are three main characteristics of variable annuities, underlining investments, the payments that that an annuitant makes into variable annuity are invested in the insurer's separate account, but their general account, but not their general account. The separate account is not part of the insurance company, is not part of the insurance company's own investment portfolio, and is not subject to restrictions that are applicable to the insured's own general account. Interest rate. The issuing insurance company does not guarantee a minimum interest rate. Licensing requirements. A variable annuity is considered a security and is regulated by Securities Exchange Commission, or SEC. In addition to state insurance regulations, an agent selling variable annuities must hold a securities license in addition to life insurance license. Agents or companies that sell variable annuities must also be properly registered with FINRA, FINRA. Variable premium purchases, accumulation units in a fund, which is similar to buying shares in a mutual fund. An accumulation unit represents ownership interest in a separate account. Upon annuitization, the accumulation units are converted into annuity units. The income is then paid in the annuity based on the value of the annuity units. The number of annuity units received remains level, but the unit values will fluctuate until actually paid out to the annuitant.